The business cycle is what drives liquidity. So we can use stuff like the ISM survey as where we are in the business cycle. If it's below 50, we tend to be in recessionary or contractionary times. If it's expanding and above, we tend to be expansionary times. But what we know is when the economy slows down, the answer to that is more liquidity, because that's how you stabilize the economy, whether it's cutting rates or whether it's increasing the Fed balance sheet. Made me think, okay, if the liquidity cycle is turned, we know what happens, which is over this period, the economy will weaken. So the probability of more liquidity, or more cowbell, as I put it, comes back into the market. And therefore, forward-looking asset prices, technology, crypto, will outperform. And that's been exactly how it's played out.
Renowned macro guru and Real Vision co-founder Raoul is highly bullish on technology and cryptocurrencies, particularly Bitcoin and Ethereum, the leading crypto assets. In a recent interview with the Bankless podcast, Pal reflects on the challenging events of the past 14 months, including collapses in the crypto space and regulatory crackdowns that affected investor sentiment. Pal emphasizes the significance of global liquidity, often overlooked in predicting cryptocurrency prices. He notes that an increase in global liquidity has historically shown a strong correlation with Bitcoin prices over the past decade. Recent data from cross-border capital indicates a rise in total global liquidity to nearly $170 trillion in June, with central banks injecting around $1.7 trillion into money markets since November. Pal remains confident in the potential for massive price gains in cryptocurrencies as global liquidity continues to rise. Despite short-term market fluctuations, he believes that crypto assets will benefit from this trend in the coming months and beyond. The interview provides valuable market insights, shedding light on the interplay between liquidity and crypto asset prices, and encourages viewers to stay informed with more expert interviews and market updates.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So there's a bunch of liquidity measures. They're not easy to do. Some of them you can get on TradingView, I think, because some people have built them. One is Fed net liquidity, which is US centric, which I don't think is the most important. And that is basically the Fed balance sheet minus the Treasury General account, which is the Treasury building or reducing liquidity, and the reverse repo. Those three things. And they actually have mirrored asset prices pretty well. But it's not all about the US, as we talked about before. So then you need a global proxy. So the global proxy that's easier for people to find is global money supply. But again, even that's difficult because there's no one measure of global money supply. So you have to kind of construct it yourself. But again, I think people have got that on TradingView now. How good it is or not, I don't know, because we use Bloomberg and Refinitiv and other data sources. And then finally, the big daddy of it all is we've got the Global Macro Investor, which is my research service, the weekly liquidity index. That's based around the G5 central bank balance sheet. So that's the US, the ECB, the PBOC in China, the Bank of Japan, and the Bank of England. That seems to explain 97% of the entire price movement of the NASDAQ and about 87.5% of Bitcoin. The reason why Bitcoin actually has a lower correlation than the NASDAQ is because of the up cycles, because the adoption rate is so high.
Because it goes up.
The blow off tops, yeah. Right? That is the reason, because the compounding of that. But other than that, it's all driven by this factor, which is the central bank balance sheet is different to the general liquidity in the market, i.e. money supply and stuff like that. The central bank balance sheet is actually debasement of currency. So debasement of fiat currency is a thing that most people don't understand because it's not obvious. But when you are printing more of a currency, particularly when all the central banks are doing it, you're lowering the denominator, which is the same why the Venezuelan stock market looks like it goes vertical. It's because the Bolivar keeps going lower. So that is what is driving almost all asset prices. So once I started adjusting for that, I realized there was two assets that did better than anything else. Everything else, like equities divided by the Fed balance sheet, is a simple way of doing it. You know, for people who can't find a larger set of thing. The S&P's gone nowhere since about 2012, since QE really became prevalent, or 2008 really. And we found the same with real estate, gold, everything. Technology, yes. Why? Adoption trends, right? Technological adoption is relentless. And the other one that beats it all, obviously, is crypto, because it's got the technological adoption and it counteracts the debasement. So once I found those out, I realized liquidity was going to become the really important driver. And I think it'll be the thing people talk about for this cycle. Usually it stabilizes first. If you remember 2018, the Fed had been shrinking the balance sheet. Most of the global central banks did. The Fed go on pause. Some of the other central banks start doing the same. That moment, assets took off. Bitcoin was up 300% into June or July of that year, then corrected into 2020. But that period of pause is like somebody taking the foot off the beach ball and it rises out above the water. Then the thing that lifts it is when they really start expanding the balance sheet, i.e. when recession is coming or you've got a banking crisis, both of which we're toying with right now. This is the summer months, so it tends to get a bit quieter, but that narrative probably picks up again and the beach ball gets lifted up by the gust of wind. So this is the kind of moment in liquidity where things have bottomed because the central bank balance sheet stopped shrinking and Japan started printing a bit. China started increasing money supply. The UK had to print quickly because it had a pension crisis. And then the Fed had to print quickly for the bank crisis. These were isolated events, but they're the markers that we know the more cowbell is coming. And then we're waiting for, okay, when do they really swing into action? Money printer go burr. You know, you can use the very simple bell curve meme of the money printer go burr. That's the one that's the big signal. So really it's all about setting yourself up for that big signal, because crypto spring, which is where I think we got to from October, tends to be choppier, harder to trade. It's not an up-only market. It tends to make good progress, but it tends to be complicated because there's a lot of opposite narratives, which we're seeing, right? People don't trust this rally because of banning or because of this, because of that.
During his discussion with Bankless, Raoul identifies two factors that he believes would prompt the Federal Reserve to take swift actions, cutting rates, and resorting to quantitative easing. The first factor is the looming commercial real estate crisis. Reports indicate that around $1.5 trillion in commercial mortgage debt is due by the end of 2025. However, due to unfavorable conditions such as higher borrowing costs, tighter credit conditions, and a surge in vacant office spaces, there's an increased risk of loan defaults. Recent data from Fitch Ratings reveals that $5.8 billion or 35% of commercial mortgages due between April and December 2023 will not be refinanced. Morgan Stanley's chief investment officer, Shillett, predicts that office and retail property valuations could plummet up to 40% from peak to trough in 2023 due to rising interest rates, making refinancing challenging for investors. The second factor contributing to the Fed's potential actions is the large amount of looming debt. Over 50% of the $2.9 trillion in commercial mortgages will require renegotiation within the next 24 months, while new lending rates may increase by 350 to 450 basis points. Considering that small and regional banks hold around 80% of outstanding debt in the commercial real estate market, amounting to a $20 trillion sector, Powell asserts that the Fed will likely need to intervene to address the crisis. Such intervention could have a bullish impact on crypto assets. Raoul Pal's insights shed light on the potential repercussions of the commercial real estate crisis and its implications for the Federal Reserve's actions. In light of these factors, investors may be keen on how the crypto market reacts. More clips from Pal's interview are available for further insights.
The proven outcome for a banking crisis is inject liquidity into the system. We also know that there's a commercial real estate crisis. So there's two parts of this crisis. One is the banks themselves having deposit flights because of the mismatch of interest rates between what they offer their customers versus money market funds, right? That's not going to stop until the Fed cut. So there's a bleed of assets that come out of the banking system. But the big one is commercial real estate. Nobody goes to the office anymore. We don't know how big that is, but it's in the $1 to $2 trillion range. I mean, that's trillion with a T. These are big numbers. And this stuff, nobody's ever going to use this offices ever again. So it's going to end up on somebody's balance sheet, and it'll end up on the central bank balance sheet. But that's probably a 2024, 2025 story when things really pick up. So what else forces the central banks into the game? It usually is the old ones, inflation falling or unemployment rising. You know, I use as a good proxy for where inflation's going to be, headline inflation is going to be in a couple of months. Just use Trueflation. You know, it's the on-chain inflation thing. That's about 2.3% 3%. I mean, I've been saying this for a while, is I think there's a probability that headline inflation, certainly PPI inflation, is negative over the summer. Now, core inflation is a bit stickier, but there's an extremely strong narrative, maybe the strongest narrative I've ever seen in financial markets, that inflation is going to be around forever and it's sticky because people pull up the chart of the 1970s and say, see, it's going to happen. They're imposing their own belief system onto markets as opposed to observing markets as an impartial participant. So I think that narrative needs to get crushed. Now, don't forget, a banking crisis is the single most deflationary thing that could ever happen, except for AI, which is the single most deflationary thing that could ever happen. Okay. I think the final part of pessimism that's washing through, most things in a business cycle terms, there tends to be things that lead and things that lag. So it looks like ETH led, I at bottom first. The thing that lags is the further out the risk curve, which is NFTs. So NFTs are having a horrific time right now. You can blame it on Blur and other stuff, but really it's a factor of NFTs are recycling of capital within the space. So when people are making money, they want to buy premium NFTs, CryptoPunks or Fidenzas or whatever it may be. And when everybody's losing money, they don't do the same. It's the same with high-end real estate. It's the same with, Rolex watches. We saw that Rolex watch prices come down because of the same reason, is once you go out, the kind of trophy assets and stuff, there's not enough money around. So that is still washing through the space. So that's I think the last part of what has to happen. And then as you say, the ETF is the chink of light on the other side. Now, the ETF in itself doesn't cause a stampede. If you launched the ETF between June and October, you would have had zero uptake. But the ETF, as price is rising, becomes very powerful. Because most people in this space are momentum investors, particularly the RAAs, the pension plans and others. Most people the institutions have done the work on this space, and all they need is price because they don't want to look stupid. Everyone's investment committees beating them over the head saying, see, you were stupid thinking about this. But everybody I speak to, it's still on their plan. I mean, don't forget, BlackRock were talking about this during the last cycle. Remember they had Bitcoin on their website and he was talking about, Fink was saying, we've had more hits on our website than we've ever had in history. They've been thinking about this through, as have most of the big players. So it feels that as the darkness is on NFTs, we see the light coming for new capital into the space, and then it flows through. And again, very typically in a cycle, you start with the benchmark asset, Bitcoin, that outperforms. Then as the capital comes into the space, because each other part of the space is less liquid, you put the same amount of money in, as it spreads down, it causes an outsized reaction in other parts of the space. So what the space does need is new capital, because we've been recycling capital for a while. It's the same with economies. There's no new investment anywhere going on in the global economy right now because of, except AI. Because of the economic situation, nobody's got money. But the moment people start making money again, it flows through, and we'll see again stuff like the ETH Bitcoin outperformance begin again. Now, interesting enough, I've been digging on work on that too, and I found that's entirely correlated to the business cycle. That I've got a certain set of indicators that kind of suggests when that happens, and it's based on liquidity, so it's the same thing. So that gets interesting to me as well.
According to Cross-Border Capital, the Global Liquidity Index, derived from monitoring liquidity conditions in 90 economies worldwide, shows a pattern of picking up again in 2023 after a sharp crash in 2022 that followed the unchecked rise in global liquidity during 2020. Additionally, the group presents a chart illustrating the striking correlation between the U.S. Fed Liquidity Index and the performance of the S&P 500. This supports Raoul Pal's thesis, suggesting that several unfolding events could prompt major central banks to activate the printers and intervene to rescue the economy. Raoul Pal's assessment of the current macro conditions and his predictions for Bitcoin, Ethereum, and the entire cryptocurrency market are based on his belief that increased global liquidity will likely lead to a positive outlook for digital assets. Given the correlation between liquidity and asset performance, Pal's optimistic stance aligns with the potential for significant price gains in the cryptocurrency space. Viewers are encouraged to share their thoughts and observations on Pal's insights in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.